The Freddie Mac Ops Risk Central function sits in the Enterprise Risk Management Oversight Division. So we have an organization for credit risk, market risk, operational risk, and models risk because our business is so model dependent. We have a separate function for that. Within Ops Risk, we have about 20 people that are in that function. Reports up to the Chief Enterprise Risk Officer, who reports to the CEO. And then we have embedded risk managers, Ops Risk managers, in the business line functions. They're matrixed back to us, but they also report into their functions. So there are about 40 people or so throughout the organization who are focused all day long on ops risk and feeding this framework. When we started doing operational risk management, all of the tools in the ops risk toolbox were on equal footing. There wasn't much difference between key risk indicators and risk and control self-assessment. We hadn't gotten to scenario analysis yet. Loss data collection, we sort of charged forward on all fronts with the same vigor, and we got a lot of data and very little information. We got the tools in place, and there was a lot of excitement initially, but things stagnated because it was just about the tools. We've reset our focus in the last couple of years. We see risk and control self-assessment as the foundation element for operational risk management. Each business unit taking a very close look at themselves and saying very simply, what can go wrong, how bad will it be if it does go wrong, and how likely is it to go wrong. Doing those things against the structured risk inventory actually sets a really good foundation. Coming from the top down, we have our TOPS risk issues discussions, sort of, what are the big things that are facing the company. So we have people generating this information at the bottom with the top risk issues sitting over it all. Then we bring them together with the other ops risk tools. So the loss data. What do the losses tell me about the risks that have been identified through RCSA? Are these things matching up? Are we getting a good view through our RCSA of what the actual risk is? Are these things manifesting? The key risk indicators, rather than a blanket of thousands of them that are going to light up and tell us about the risk to the firm, what are some important ones that we're led to by the risk and control self-assessment so that we can monitor the direction that the risks are going? Scenario analysis. We've identified an issue through risk and control self-assessment, or from the top risk issues, let's set up a fact pattern and play it out and see what happens. Let's exercise our controls on paper to see what the outcomes really are. So those tools sitting on top of the RCSA and informing up into the top risk issues really helps us manage operational risk instead of just report on it. We report on a monthly basis into the Operational Risk Management Subcommittee, and that report gets to the Enterprise Risk Committee, the C-level committee, each month. The operations risk item on the agenda is at the risk committee at the board whenever they meet. So there's a no less than annual review sort of by charter, but they've gotten very engaged, so at each meeting where they're talking to them. The most important reporting that we do is around our top risk issues. So we have a report that's sort of set out by the things that are of most concern to Freddie Mac. We have a statement of risk and a risk assessment, some commentary from the business area, and we try to be very disciplined in talking about these risks in terms of likelihood and severity, talking in the common language of risk. We also have a synthesis of our loss data. That's an important report that feeds all the way up through the framework. What the losses are, what's driving them. Those are the two key things that go up. We have a lot of other reporting, but those things are synthesized into something that's digestible for the board, so that we can, you have limited time with the board, so you need to really focus on the important things. We have a couple of graphic keys around what's high risk and what's a moderate risk, what's a low risk, that have proven pretty powerful in getting them to focus in the right area. But those keys are not the information. They're just to get them to look in a particular place. The text is really what's there. I mentioned being factual. You want to be factual, but you don't want to overload what you've written with a lot of facts and figures. You have to have those facts and figures available, but they usually go into an appendix. There are not a lot of charts and a lot of numbers with the reporting up. There are some paragraphs, a couple of numbers for them to focus on, but the real detailed stuff is all in the appendix. So if they're interested, if they start asking questions, you can refer them back to it. But you want to have them ask for the numbers and be able to provide them rather than seeing their eyes glaze over. The way that we know that we're on target in the Freddie Mac ops risk function is whether we're in trouble or not. If nobody's upset with us, we haven't done our job. We're just collecting information. If people are asking questions, then we're doing our job because we're trying to stimulate questions. We are not trying to run the company. We're trying to give the people who run the company the information they need to run it right. So if people are asking questions and someone's upset with us, we know it's working. And that's been a change as we've moved into this second generation program that has the engagement from the top with the strong governance around it. We are hopping a lot more. One of the things that we've learned over the years is to synthesize the information that you've got. Don't try and present a lot of data. A lot of facts and figures are very important to form the story, but it's not the story. When you're reporting to senior people, when you want engagement at the top, you need to bring them a meal, not a bunch of ingredients. You really need to, the ops risk manager has to do the hard work of translating the information you gain through the tools into the story so that you can stimulate a discussion of the risk issue. That's the best outcome of an operational risk management program, is discussion of the business risk issues so that you can make decisions about how much risk do you want to take? What are we going to do with this risk? Do we need to fund systems projects and things to deal with it? How are we going to change things? You want a good business decision, and you need a story to stimulate that decision, not a graph necessarily or a page full of numbers. So turning the ops risk tools into a story is the job of the risk manager. It's important when you're doing all of this work to avoid the assignment of blame. It's someplace that you can be driven. You can get very event driven and wind up in sort of an assignment of blame situation. That's really important for ops risk managers to stay out of. If the function gets a reputation as a witch hunt, it'll become ineffective very quickly. People need to be able to trust that you are working to resolve the risks, working to resolve the problems that are allowing risk to manifest, and not trying to assign blame.